Hey guys, welcome to another video. On this episode, we'll be talking about 3 stocks, actually ETFs, that you should be looking to if you're looking to invest in FAANG. And if you don't know what that means, stick around. We'll talk about what that acronym stands for and why it's important to start investing in them. Hey guys, welcome to my channel. If you're new here, I'm Romel, and on this channel we talk about all things related to finance, investing, and building wealth. We discuss mindsets, strategies, techniques, and resources to help you in your journey to build wealth. If you haven't yet, please subscribe. We produce new content every week. Alright guys, so the first thing that you should know about is what FAANG means. FAANG is actually an acronym, F-A-A-N-G. There's 2 A's in there. And the reason for that is that FAANG stands for Facebook, Apple, Amazon, Netflix, and Google. Although it should probably be changed to FNAAA, and you'll see what I mean at the end of the video. Alright, so why is it important to look into FAANG stocks? FAANG represents some of the biggest companies in tech, and they've seen some major market movements over the past couple of years. Everyone knows that Amazon has been going through the roof in terms of their share price and performance. Same thing can be said with Google, Apple, Facebook, and Netflix. All of those companies have seen some great returns. Generally, technology stocks have been a great place to invest your money because of how rapidly our technology is advancing. If you're looking to invest in tech stocks, then those 5 companies are ones that you'll definitely be on the lookout for. Now, let's talk about the differences between why people invest in stocks versus ETFs. The first reason is price. Right now, Facebook is currently trading at $230. Apple is currently trading at $369. Amazon is trading at $3,000. Netflix is currently trading at $480. And finally, Google is trading at $1,508. As you can tell from those individual stock prices, they are not cheap. If you want to start investing in one share of those companies, then you're looking to spend a couple of $1,000s. The reason why ETFs are a great alternative to buying individual stocks is that it allows you to get shares or partial shares of those companies. ETFs are not one stock. ETFs are basically groups of stocks with different weighted percentages of their individual holdings. What that means is that if you buy one ETF, it could, let's say, have 10% of its holdings in Apple, 5% in Netflix, 3% in Google, and so on and so forth. And those aren't actual percentages. We'll go into that further along in the video, but that's just some of the reasons why ETFs make sense to invest into rather than individual stocks. Alright, so one of the things I said at the beginning of the video is that it probably shouldn't be called FAANG, it should be called FNAAA. And the reason for that is that if you actually look at the stock market, then most of those FAANG companies start with their acronym with the exception of Google. For example, Facebook does start with F, Apple starts with A, Amazon starts with A, Netflix does start with N, but Google is actually known as Alphabet. If you actually go onto the stock market and try to look for Google, you'll see the company Alphabet. The reason is, according to an article by Investopedia.com, Google is a household name known around the world, but in August 2015, the company renamed itself Alphabet and Google a subsidiary. Alphabet as a parent company allowed Google to more easily and logically expand into domains outside of internet search and advertising to become a technology conglomerate. Under this new corporate structure, the company runs lesser risk of antitrust violations and is also better able to account for income streams from various subsidiaries. So the reason that it changed its name was that in 2015, it was looking to diversify itself into other business ventures, not just internet search. That's why if you do look at the stock market, it should actually be called FAAN, F-A-A-N, not FAANG. There's no G in any of those stock acronyms or stock ticker symbols. Alright, now let's get into those 3 ETFs. The first ETF I'd like to discuss is Invesco QQQ Trust, ticker symbol QQQ. Some facts about this company is that the net assets is $83.5 billion. The expense ratio is only 0.20%, which is one of the lowest ones among the 3. Also, the 1-year performance is 14.9% and the dividend yield is 0.85%. One of the things you have to look at when thinking about ETFs is the holdings it has and how much percentage of each is currently in their portfolio. According to its website, its top holding in information technology is Apple at 12%. In communications, which includes Facebook, Google, and Netflix, it has Facebook at 4.15%, Google or Alphabet at 3.71%, and another Google, Class C, at 3.62%. Netflix has a relatively lower share at 1.94%. For consumer discretionary, which includes Amazon, it has Amazon at 10.47%, and also it includes Tesla at 1.94%. Having Tesla as one of its holdings is a big deal because 3 months ago, Tesla was actually priced at around $800. It's currently trading at around $1,400, so it almost doubled its value in just 3 months. There's been a lot of hype about Tesla, and Tesla is one of the up-and-coming stocks to look into. All right, some good things about this ETF. It has a lot of great holdings. It has all of the FAANG stocks, and it also includes Tesla. One of the other positives is that QQQ actually does have a dividend yield. For those dividend investors, dividends are a great way to start a passive income stream for yourself. All right, the second stock I'd like to talk to is one called pniq. Some facts about this stock: the net assets is 459 million. The expense ratio is 0.62%, which is one of the higher ones among the three that I'm talking about. Its 1-year performance is 2.7%, and it doesn't have any dividend yield. Regarding the exposure into FAANG stocks, it currently has 6.8% in Facebook, 10.41% in Amazon, 3.66% in Netflix, and 7.54% in Alphabet, also known as Google. The last stock I'd like to talk about is FDN. This is the First Trust Dow Jones Internet Index Fund, FDN. Some facts about this fund or ETF: its net assets is 6.7 billion. The expense ratio is 0.52%. 1-year performance is actually negative 1.7%, and it doesn't have any dividend yield. Regarding its holdings, it currently has 41 holdings, and its top one being Amazon at 10.35%. Its second highest holding is Facebook at 6.69%. Its third one is Netflix at 5.18%. And regarding Google or Alphabet, it currently has Class A at 4.27%, and it has Class C at 4.17%. One thing about this ETF is that it doesn't have any Apple holdings. All right, now that you know those 3 ETFs, which one are you looking to buy? Some of the pros and cons of each are whether or not they have dividend yields. As a recap, QQQ actually is the only one of those 3 ETFs that have a dividend yield. As a recap, FDN had its highest holdings in Amazon. However, if you're looking to jump onto the Tesla hype, then perhaps QQQ is the one for you. Let me know what you guys think. These are just 3 of the ETFs that I found with FAANG or FAN holdings, as I'd like to call them. If you know of any others that you think would be comparable to these, leave a comment in the description down below. I'd be interested to take a look into what else you guys are investing into. Quick bullet points about why ETFs make sense compared to regular stocks. The first is that the cost of buying and owning shares of FAANG stocks. It's not going to cost you thousands of dollars. Instead, it's going to cost you only a couple of hundred, and you'll be fully diversified into all of these internet and tech related stocks. The second one is dividend yield. Some of those tech stocks don't have dividends. QQQ is one of the ETFs that does actually issue dividends. So if you're looking to invest into those stocks while also making another passive income stream, then that's something you'll look into. Some of the drawbacks or disadvantages of having ETFs rather than individual stocks are the cost of ownership. ETFs have expense ratios, which means that you are paying a very small percentage fee to owning an ETF, while owning individual stocks, you don't pay fees. I guess that is unless, of course, you are using a commission brokerage. However, Robinhood, M1 Finance, Fidelity, I think most of those have changed their business model to be commission-free trading, which means that you're not going to get charged a fee to buy stocks. Take a look at it. If you don't have Robinhood or M1 Finance, I'll leave links in the description down below. Start your account and invest at least $100 in each. For Robinhood, I believe you get 1 or 2 free stocks. For M1 Finance, both you and I get $10 toward your investing account once you fund it. All right, guys, hope you guys got some new information or at least saw quality and value in those 3 ETFs. Let me know what you guys think. If you're looking to connect with me on other social media platforms such as Facebook, Instagram, or Twitter, I'll leave links in the description down below as well. Thanks for watching, guys, and I'll see you on the next one.